Well, welcome to Farms.com Risk Management Daily Bottom Line for February 3rd, 2015. I'm Mark Lottie. Today we're going to look at hedge funds. So, managed money, also known as speculators, cut their net long positions in futures and options of the top 13 U.S. traded agricultural commodities by nearly 90,000 contracts last week. The sell down was the biggest in 6 months and reduced the net long positions to 350,000 contracts for the first time since October of 2014. So the latest report, corn is now long 169,000 contracts. That's off 27,000. Soybeans is now a short 33,000 contracts. That's up 25,000. And wheat is a net short at 12,000, and that is up 9,500 contracts. So looking at corn, the bearish sentiment was led by the Chicago contracts, and we are seeing net long corn by more than 27,000 contracts, just under 170,000 lots, and that's the biggest sell down in corn in 8 months. Soaring U.S. dollar and the crude oil price decline have really underpinned corn prices, dropping over 50 cents a bushel since the end of 2014. Soybeans raised their net long or net short position by more than 25,000 contracts, taking it above 33,000 lots, returning close to the 8-year high of 39,000 contracts. And then hedge funds also extended a net short position by more than 9,500 contracts, taking Chicago wheat above 12,000 lots. However, with the remaining below the record net short position of 78,000, almost 79,000 lots reached in September. And then looking at lean hogs, after cutting their positions for 6 consecutive weeks, have added to their net long positions to bring it up to 34,000 contracts. So the bottom line, hedge funds have started 2015 by liquidating their net long positions that they added to at the last quarter of 2014. This is causing corn futures to fall 50 cents, soybeans $1.34, and Chicago wheat down $1.84. Part of the selling was due to lower crude oil prices and the soaring U.S. dollar. In the process, grain futures become near-term oversold, and when crude oil started to finally close higher in the past few days with the fall of the U.S. dollar, it caused the hedge funds to buy to start covering a rally of some of that short positions. We called the top in crude oil futures in July of 14, called the bottom in the U.S. dollar in July of 14, and a top in the Canadian dollar July of 14th as well. We also called a bottom in grain prices in October of 2014, called a top in wheat at the end of 2014. However, we have not yet called a bottom in crude oil or in the Canadian dollar or a top in the U.S. index, but we are close. Again, we're in that 8th inning stage. The February WASDE report update scheduled to be released on the 10th will shed more light onto whether we add to the rally or resume the downtrend in grain prices. The USDA will need a report lower ending stocks across the board to spark any type of a rally. That is all for today. Until next time, thanks for watching.